Thank you for joining us here for today's episode at the Bruce Group. And today we're speaking to Bob Lyddon, who's written an excellent book for the Bruce Group on the EU's shadow debts and liabilities. Mr. Lyddon, thank you very much for coming to speak to us today.
Pleasure.
Now, Mr. Lyddon, he is famous for, as it were, getting into sort of financial weeds of a lot of these issues. I believe you recently appeared on GB News to talk about about Derby County FC.
Yes,
and
soccer. Yes.
yes, and I think, and that's an area I think that we here at the Bruce Group have been talking about quite a bit. And I believe, especially with the latest liquidity,
Yes.
you've had a few words to say. And well, I guess if we could start talking about the events of the last few weeks, and it's been described as a sort of bank contagion. We've heard about, firstly, the fall of Silicon Valley Bank, the acquisition of its UK arm by HSBC for that symbolic £1, and then the fall of Silvergate, Signature, and other bank bank runs per se, banks deeply embedded in the cryptocurrency sector, etc. And this has even spread to Credit Suisse, with I believe takeover talks in play as we speak. And you've been very, very critical of the narratives regarding Silicon Valley Bank UK's acquisition of HSBC, with the claim of no taxpayer money being involved in the deal. Could you explain to us for a moment why you do not believe that there won't be any taxpayer involvement, and perhaps what will this mean for moral hazard?
I've been critical because there is taxpayer support for the rescue by HSBC, because HSBC is allowed to hold Silicon Valley Bank UK within its ring fence, as it's called. This is supposed to be the safe domestic bank where nothing can go wrong.
Mm-hmm. So I guess
it shouldn't have international investment in it. It shouldn't have high risk business in it. And Silicon Valley SVB is high risk. So putting it in a bank that is next to contains the current and savings accounts of UK consumers and businesses puts those consumers and businesses' money at risk. I mean, they're taxpayers, right? You know, they're the same constituency. But if the HSBC fails, okay, you can say that's a remote possibility. But if it does fail, there's a claim through the Financial Services Compensation Scheme. This is the deposit insurance scheme based on the EU model, whereby depositors get reimbursed by the government up to £85,000 each. The scheme is not funded. There is no mega £1 billion fund. The scheme gets funded via the issue of new government debt. And that debt is the responsibility of all consumers and businesses in the whole of the UK. So there's support at two levels. There's no taxpayer money. That's what the Treasury said. There's no cash. It doesn't mean there's no support. But there's an important point that comes for the whole idea of deposit insurance. None of the countries in the EU and the UK can really want to issue this new debt to fund the compensation scheme. The other thing they don't want to do, especially when it's sectors of the economy that are favourites, like tech is for the UK, they don't want to cause those depositors who had more than £85,000 in their account to just receive what are called capital-like instruments in a new bank, if there even is one. So in other words, they lose that amount. So there's two areas where this whole deposit insurance scheme devised by the EU fails. Governments don't want to issue new debt to fund the scheme, and they don't want to cause or crystallize the loss of the depositors that have more than, well, it's €100,000. So in other words, the whole scheme is a dead letter. And whenever there's been a bank failure, governments have lined up what's known as a white knight. So it was Santander to acquire Banco Popular. It was Intesa Sanpaolo to take out, a couple of savings banks. Now it's HSBC to buy up Silicon Valley Bank UK. So constantly, whenever there's an issue, and UBS to take over Credit Suisse, because all the schemes are the same way, it's never done according to the book. And there's always some great reason for circumventing the law. And in this case, the government has bent the law to help HSBC and to help Silicon Valley Bank, and really to help Silicon Valley Bank's customers, who are in a sector that the government ministers involved have said is critical to the UK. I'm not sure the rest of the population think it's critical, but they do. So there's always a reason. But the lessons for the EU on an EU level is none of these deposit insurance schemes are funded. Governments don't want to issue new debt to fund the schemes, and they don't want to push through and cause the larger depositors to have to take a loss. So in other words, at every turn, they'll have to circumvent the law they've put in place.
So I guess that there's more to this issue than meets the eye, and I guess we'll have to see down the line with however this sort of the so-called bank contagion continues, whether the FDIC in the US or the Bank of England in the UK, or whatever, or any of the other authorities elsewhere, and how they respond to it, and whether it has any of these such long-term effects, if there's really more to that meets the eye.
Yes, indeed.
So I guess moving on to your book, which you've written, I believe in that you've completed in late 2022 on the on the European Union monetary system's hidden liabilities, its shadow debts and liabilities. Just to get started, could you explain what shadow liabilities are and how they pose a risk to the true financial position of the European monetary system?
That's right. Well, the indebtedness of member states is principally measured via a definition called general government gross debt. So when it gets into the press that Germany has a debt to GDP ratio of 69%, that is the ratio of its debts as measured by the debts of what are known as general government entities, divided by its GDP. And things like compliance with the Fiscal Stability Pact or the Stability and Growth Pact, which are critical to the euro, are measured on that ratio. The trouble is that general government omits two major areas of debt and liabilities. It's not just the direct debts, it's also where member states guaranteed debts. And if you I think of it like the ultraviolet light and infrared. We can't see either, but they exist. And the ultraviolet is above the member state level, and it debts in entities like the European Union itself, the European Investment Bank. They fall outside the definition of general government. Even the central banks do. They're not part of general government. Then below the member state level, you have a tremendous number of public sector entities, many of whom own one another. So they're things like that might be in Singapore or US or UK privatized, but they're not. In the EU, they're mainly public sector. Water, electricity, transport, regional development. There's a whole labyrinth of entities, and they can indebt themselves. So here, for example, in the UK, there are quite severe restrictions on public sector entities indebting themselves. But that's not the case in the EU. The controls are much looser. So you not only have public sector entities outside general government with huge debts, but you also have a financing template which looks as if it's a private sector deal. For example, a wind farm, energy generation. But the viability of the project depends on a contract between the project sponsor and a public sector entity. And the loans that the project sponsor and company takes on, the credit risk on that is entirely dependent on that contract. with a public sector entity. The point being, it's a commercial contract, not a debt contract, so it doesn't appear on the balance sheet of the public sector entity as a loan. So it's distanced. And there are some big schemes around, like Invest EU, which really they're building up, aggressively building up that shadow public sector debt. And it's enormous. You know, the total is over 10 trillion euro of all of this, which is, you know, another 70% of EU GDP. So the admitted to debts are like 90% of GDP. The total debt is actually 160%. And why that is so damaging to global stability is that other counterparties, in fact, counterparties within the EU and outside, they have to measure their risk. And against their risk, they calculate how much capital they should hold to buffer themselves against the risk of loss. Or else, if there's something like a derivatives exchange, they have to ask for collateral. Well, the effect of this missing debt is that counterparties underestimate the degree of risk they're taking in dealing with these counterparties. Therefore, they hold far too little capital, or when they take security, they take too little security. So in other words, there's a large missing amount of capital and collateral in the global financial system deriving from this problem. It's trading on margins that are too thin.
Hello, can you hear me? Hello?
Yes, Chris, did you get all of that?
Yes, we've recorded all of that. Sorry about.
Okay, let's carry on then.
Mhm. All right. So earlier one of the things you did. So earlier one of the things that you did mention was about ultraviolet light versus red light. Light that's a, as it were, monetary policy that goes above the member states in the European
Sorry,
Union.
I'm not getting it, Chris.
Oh, sorry. Seems to be a signal issue. So earlier, you talked about ultraviolet light, UV, and red light. Light, as it were, policy making that is
Yeah.
above member states, and then the national central banks of those member states, and below that are those public sector entities. And I guess
Yes.
we move on here to the question of, and I guess to clear the air a little bit here, because this is somewhat of a complex issue. What would be the structure of monetary policy making in the European Union? Now, you've talked about that a little bit just now, but what's the relationship, as it were, or how is policy making done between the central banks and monetary authorities in the EU on that level?
Well, I think it's more or less all in the hands of the EU. So it's been proved by various court cases that have happened in Germany that the European Central Bank is only accountable to the European Court of Justice. It's not accountable to member state authorities, and it's scarcely accountable to the European Commission or the European Parliament. So they've lost control. The talk about EC or central bank independence, but this has gone to such a degree that the European Central Bank is basically just accountable to itself. All right, they have as shareholders the national member state central banks. They're supposed to act as a control, but who's controlling whom? Are the national central banks controlling the ECB, or is the ECB controlling the national central banks? If you have to ask a question like that, it means the governance is not clear. But the direction of travel has been to autonomy for the ECB and very little control for the member states. And the voting systems are arcane. So it's very difficult to remember what block of central banks can outvote the others. But effectively, whenever you get an organization like that, it actually means that it's the executives that have de facto facto control, whatever's written down, they're in the position to do their own thing, do things as they like without member state control. I mean, then the last kind of institution that the European Central Bank is answerable to is member state parliaments. They have no direct line or even dotted line accountability. And that's the problem. Well, that's part of the problem, but it also reflects the fact that the euro as a currency does not have member state backing, explicit member state backing, as the pound has in the UK or the dollar has in the EU. You know, the ECB has very low capital compared to the size of the operations it's undertaking. Or in fact, it doesn't even undertake the operations, the national central banks do. And if they make a loss on those operations, if they crystallize a loss, they pass it back to the European Central Bank, who allocate it across their shareholders. Now, up to now, the ECB never made a big loss that it had to crystallize like that. And losses that have not been crystallized don't count. But crystallized losses, they wouldn't have to be very large as a percentage of the size of the operation. You know, you've got operations, trillions of euro. The loss would not have to be very large as a percentage of the operation size for the ECB's capital to be wiped out. And the mechanism for getting more money from the member states is, first of all, they have to organize a capital call on the member state national banks. Then the member state national central banks, who equally don't have much capital, have to get the money from their own treasury, you know, the government finance ministry. Well, this is not as automatic as in a country that has its own currency. So there's a weakness, a big weakness in how the European Central Bank's operations can get funded by the member states that you don't have in a country like Switzerland, the UK, or the US. And in a crisis, that weakness is going to be tested.
So as it were, the system that has been built, as it were, you could say, has spread itself a bit thin, and the many layers between the different bodies within the European Union and its member states and the Brussels entities might exacerbate particular problems when a crisis does come. And of
Yes,
course, in the
but I think
United,
it's up to now, it's quite helpful because the thing is a halfway house between having no common currency and having a full sovereign currency like the UK or the US. And at the moment, it's quite helpful to be able to incur something like 400 billion euro of new debt a year, and it doesn't show under general government gross debt. That certainly helps oil the works. And if then they went to full union, those debts would be visible. So for the time being, it probably helpful. It has been helpful of the euro single market on the productivity of the overall economy, because this extra 400 billion per annum is like a fuel to keep this steam engine on the road. If they went to full monetary union, that extra debt would become fully visible. So it has its advantages up to now, but in a crisis, things will get very difficult because there's an awful lot of implied backing. There are explicit guarantees, but there's also implied backing, such as for the European Central Bank. Could Germany, the Bundesbank, if the European Central Bank says we need another 100 billion in capital, could the Bundesbank really say, well, sorry, find somebody else to buy that, I'm not subscribing? They're not legally obliged to subscribe, but the idea that they wouldn't would say, no, sorry. You find the issue, they would have to buy in, because if they didn't, that's the end of the euro and pretty much the end of the EU.
Yes, I think that makes sense. I guess in the United Kingdom, the Bank of England governor can be hauled before the Treasury Select Committee and grilled by members of Parliament, and so can the Chancellor of the Exchequer. But the same cannot be said within the Brussels structures or the Brussels entities.
Yeah,
And I guess here we move on to ask, well,
yeah,
in wider detail, could you explain for a moment how, because you start with talking about sovereign risk and how pre-euro relationships, monetary relationships between states and various public sector entities did work. So could you
yes,
explain in a slightly wider detail how the euro and handing over certain levers of monetary policy from the member states, or those NCBs, to the ECB and the EU monetary system, how that has undermined the certainty with which sovereign risk is associated? And this is one of the areas you've waded into right off the bat in your book.
yes. So, yeah. So even where a currency, let's say it was the Italian lira, was in the European monetary system, this ERM,
Mhm.
the exchange rate mechanism, as it is called, there's no doubt that Italian government bonds were the sole responsibility of the Italian government and the Italian people. So they had their own currency. They set their own interest rates. Those had their effect on foreign exchange rates. But of course, being in the exchange rate mechanism, they didn't have full freedom. And this is one of the reasons why the UK left the ERM, is to re-establish freedom over setting of interest rates, money supply. You know, countries don't control foreign exchange rates, but they influence. The member states have no influence whatsoever over the exchange rate for their exports and imports between other euro member states, because they're all using the same currency. They have no influence at all over the setting of interest rates, except for having their governor sits on the European Central Bank Governing Council. So they do have some influence, but really their influence is diluted. It's very weak. So they've given over control of interest rates. The ECB dictates the money supply. Their decisions govern the money supply. So it's the ECB that is really acting to control inflation or increase it, and it's the ECB's decisions that influence the exchange rate of the euro to the dollar, to the pound, the Swiss franc, and so on. So effectively, they've given away all the monetary levers. And the only one really they have left is indebtedness. That supposedly is controlled by the Fiscal Stability Pact and the Stability and Growth Pact, these supposed limits on the fiscal deficit and national debt. But really, the book is about how those controls have been circumvented, particularly that on indebtedness. And even it's incredible that, I thought the fiscal deficit for a year was the difference between last year's national debt and this year's, but it isn't, apparently. The two are different. So there are these important safety valves. Effectively, it's the only safety valve that a member state still has. It can build up shadow debts to really, in some ways, be constantly bailing itself out of the difficulties imposed by the rigidity of the euro, that the interest rates and the monetary policy of the ECB doesn't really reflect their needs. They become short of money as a result. So they're allowed to build up these shadow debts. And I say it's 400 billion euro per annum since the euro was started. That's what is apparently needed to keep the euro's steam engine on its tracks.
So it's a sort of a hamster wheel cycle of problems. in which
Yes,
the very nature of a member state and an economy being in the eurozone create and those very constrictions through the fiscal stability pacts and all the various requirements which cannot be complied to, which create all of these problems, and in which then an exception, a sort of escape valve, is permitted to not really, as it were, hide or accumulate these debts in a
yes,
less obvious way, um, such that it creates a lot of these problems
yes,
we're talking about.
that's right.
I see. So I guess we move on to the question of, well, does this complex monetary system constitute as constitute a modified iteration of moral hazard, or is this really a different beast altogether? Given that the sovereignty that a member state exercises over its own monetary policy is, as you said, significantly diluted.
Well, what I see as moral hazard, people take risks, they could lose money.
Mm-hmm.
Well, the difficulty is that the EU economy has cramped risk taking. It's highly regulated. There are high entry barriers.
Mm-hmm.
It's effectively a low risk, low return economy. And that's part of the problem. It's a kind of stagnating economy with too big an amount of influence for the public sector. The public sector's too big, and it's not even recognized how big it is because of these shadow activities. And the ethos is that nobody can lose. You can't lose. That's why they won't allow depositors with over €100,000 in a bank to be bailed into some nebulous new bank where the capital-like instruments they would be given are probably worthless. They can't risk that. But they can't risk putting a bank through resolution because they'd have to borrow the money at the member state level. So even their own mechanisms can't be used. I think the moral hazard is, yeah, they're in a mindset when we have low risk, we have low returns, therefore we have low risk. So there can't be moral hazard. But why have we got low returns? We've got low returns because the economy is stagnant, high entry barriers, very difficult for new competitors to enter the market. And that's mainly because of very high technical standards, which supposedly are for health and safety or greenness, but actually it's to stop foreign competitors. There are barriers to imports. So what do you get? You get a series of cartel-like sectors which don't grow dramatically because everybody has their known sector. For the suppliers, it's low risk, but it also is quite low return. That's where they've got themselves to. So they've really got themselves into an economy without the concept of moral hazard. Yeah, they've to some extent eliminated that from being a possibility. But the flip side of that is you can't have high returns. You can't have wealth creation without moral hazard. They want wealth creation. They sit there wondering why it isn't happening. Well, you've got to have both sides of the coin, not just one of them.
Oh, I see. So really a different beast altogether. And
Yes, I think so.
yeah, yes, and I guess looking at a lot of these, looking at slow growth and a low growth economies, I guess this comes to show some of the statistics that you have published in your book, and
Yeah,
some of the calculations that you've been able to produce have produced some remarkable statistics. You say here, I believe, and I'm quoting here, that the EU public debt and contingent liabilities are in the region of 23.1 trillion euros, or 160% of GDP. And you say that consequently, banks that take risk with the eurozone public sector have underprovisioned risk on their own side, due to the significant underestimation of these public sector liabilities. But
yes,
so surely, I guess organizations who are interacting and who are the counterparties to these the EU have factored this in. Surely wouldn't they have factored it in and wouldn't merely look at Eurostat's presented figures? on general gross government debt? Wouldn't they look beyond that a little bit?
Well, you'd have thought so, but the ECB is very keen on public credit ratings. So its collateral and lending policies are all based around public credit ratings. And the rating agencies don't seem to have noticed this. I only can conclude that because the UK has a debt to GDP ratio of about 94%. It's rated AA by Standard and Poor. France has a AA rating with a debt to GDP ratio based on general government gross debt of 113%. But actually, if you factor in all these other shadow items, it's 178%. So the Germany's position is meriting a credit rating, not of AAA, but of about A minus on the Standard and Poor scale, if you factor in all these shadow debts. So no, I don't think the banks have recognized this, and they haven't done that because the credit rating agencies haven't done that. The banks look at the credit rating agencies. They have their own ratings-based, internal ratings-based methodologies, where the tendency is, as soon as they see a counterparty that's public sector, oh, that's 0% risk weighted. So, you know, the member state governments should not be 0% risk weighted on principle because of those sovereign risk issues we were talking about. Mm-hmm. But in the EU banking system, they are 0% rated. That reflects the credit ratings from the agencies. So it all goes round and round, and everybody's relying on one another. And I think that if they did realize this, the rating agencies or the banks, they would be horrified, because it could cause the whole system to collapse, because the capital just isn't there. The capital is not there in the banking system to provision their business with the EU public sector at a correct level. And this is also why the credit rating agencies have to be approved by the EU. So they're approved in order to give the correct opinion. And by comparison, you know, the UK's financials look fantastic compared to this. We should be AAA. If Germany's AAA, we should be AAA. But that's not saying that I think the UK should be AAA. But we don't have a level of supranationals above the UK. The government is the top. We have used financing structures in the past, particularly in Scotland, called Public-Private Finance Initiative, PFI. Mm-hmm. Yes. These structures which are now discredited. Mm-hmm. And we have tight control over borrowing by other public sector entities. So our debt to GDP here of 94%, if there is anything in the shadow, it's probably 5 or 6%, not 70%. So we should be considerably better off. But by the same token, the EU, all the supranationals and the member states should not have the credit ratings they have at the moment. But in many ways, it's the credit ratings that's keeping the whole thing together. Because if there were lower credit ratings, then the amount of capital that would have to be inserted, it just isn't there. You know, what are the banks going to do? Try to issue AT1 bonds? Good luck with that. Issue new shares? They're not going to get that subscribed. So the money just isn't there in the system to provision the risks properly, and that's why it's a threat to global stability.
I see. And one of the things you do look at, when you look at the general history of the European Union and its very, very complex monetary system, is the many, many layers and the many, many programs and many, many layers that add to this web of interdependence, as you've just described. One of them is,
yes.
And of course, you've mentioned Next Generation EU, the Next Generation EU bond rollout, the sort of post-COVID recovery program, And you've also mentioned the response to the global financial crisis of 2007 and 2008. Here you describe the inflated figures and faulty accounting for assets. Could you explain how some of those various new policies launched at the time, such as the European Financial Stability Mechanism, the EFSM, the European Financial Stability Facility, EFSF, the European Stability Mechanism, goodness, lots of words,
Yes,
and the ECB Asset Purchase Program,
yes,
how they add new layers to this complex web of shadow debts and liabilities?
yeah. I mean, those are schemes which sit at the ultraviolet level. They're
Mm,
above the member states. So
yeah,
the European Financial Stability Mechanism and the Coronavirus Recovery Fund, known as Next Generation EU, those are borrowing schemes by the EU itself. So those are the responsibility of all the member states. And if 27 of them couldn't pay back, the 28th has to pay everything. And this is why people use the phrase, it all tracks back onto Germany. Now, other schemes like the European Financial Stability Facility and the European Stability Mechanism, their guarantee structure or support structure is country by country up to a maximum amount per country. But still, these mechanisms have taken on debts for which the member states have issued guarantees. So in that case, it's a contingent liability. The member state has a responsibility to pay up either on a guarantee or they subscribe shares which are only part paid. So they have an unconditional responsibility to pay up the difference between what they already paid and the nominal amount of the share. And that's unconditional. So that's effectively a guarantee. So those two bailout mechanisms have their own debts, but rely really entirely on the member states who are not the borrowers. Here you get into this thing where all the member states are guarantors, including the ones that are borrowing from it, from the mechanism. But that can't be right, because an investor, knowing that a portion of the guarantors needed to borrow from a bailout, they're not going to want to rely on those member states. In fact, what happens is you get a facility with a very impressive and large nominal size, but then the contributions of the borrowing member states have to be deducted back to determine what the actual firepower of this mechanism is. So in the case of the ESM, the 3 or 4 member states who are borrowers from it, their guarantee amount has to be deducted back from the lending capacity, because they can't both be a borrower and a lender or a guarantor, because have failed. You know, Greece can't be relied upon. If it can't pay back the debts to the ESM, why should it be able to pay up on its guarantee to the ESM? It's not going to. So you have this circularity in all of these mechanisms. And particularly regarding the ESM, you have the situation where on the face of it, it has enormous firepower and is liquid. But I've pointed out 2 areas. First of all, it puts the guarantees, the unpaid guarantees, on its balance sheet. No, that is not an asset. No, they have to be off the balance sheet. Then half of the bailout loans are classified as treasury deposits. No, they're not. They are bailout facilities. So the ESM's balance sheet right now should be much shorter than it actually is. And not only that, if you look at a country like Italy, if the ESM were to be a major part of the bailout of Italy, it simply doesn't have the resources, because Italy's guarantee would have to be deducted back from the ESM's firepower to see how much it could do, and it's insignificant. It's actually very insignificant. The whole thing is really a bit of a sham. Now, the ECB asset purchase programs, another type of beast, a lot of that is invested in member state government debt. And there, I've tried in the book not to double count. So I don't double count that. It is already member state debt. The big issue there is, and this is what happened at Silicon Valley Bank, it's fixed rate securities. So the asset purchase programs contain fixed rate securities. So how much have they fallen in value since the last accounts? Now, the point is, those debts, that if there's a loss, a mark-to-market loss does not have to be passed back to the ECB, but a crystallized loss does. So the ECB asset purchase programs are almost exactly the same position as Silicon Valley Bank. They're going to have to hold to maturity. The issue for Silicon Valley Bank was the losses, the mark-to-market losses in its hold to maturity portfolio were the same as its equity. So it was actually insolvent. It shouldn't have been allowed to do that. Now, there's no reason the ECB can't just hold the securities at face value in its various portfolios until maturity. I'm not sure it even has to mark them to market, but there is a big loss in there. And if the loss was crystallized, it would trigger that mechanism I described a few minutes ago of the ECB asking for more capital, the member state central banks having to go to their treasuries to get the money, and the fact that in theory it can be refused. So this is literally a labyrinth. Each mechanism has its own way of tracking the debt back to the member states. And also, it's not just the percentages. The percentages are generally in the region of what's the size of that member state's GDP compared to EU GDP. They differ a bit. There's some variations. But the biggest difference is if another member state doesn't pay, do the others have to step in and pick up the difference? And the answer to that in several cases is yes. Why? That's why there's this complacency. It all tracks back onto Germany. But if you then add up, as I've done, everything that financial markets thinks tracks back onto Germany, that's 3.5 times Germany's GDP. So can they really afford to pick up everything that tracks back onto them? Well, no, they can't.
So what's happened here, and some of the programs you've described are close to anything from fattening a turkey for Thanksgiving.
Yes.
Well, for lack of a better word, a generous description of it might be poor accounting. So fattening a turkey for Thanksgiving or holding a basket of rapidly rotting eggs, all of which has to be sustained by money that could well not be coughed up to sustain at all. So I guess thinking about it now, we can compare this to the Bank of England and the Bank of England's requirements, which is what you've done. And you've compared the Bank of England's requirements to those of the ECB. And the Bank of England, you conclude, has higher standards. It has a base haircut structure with uplifts, while the ECB
yes.
You say that the euro system can be said to be taking much more risk than the Bank of England on ostensibly identical operations. Given the EU's reputation as a sort of world leader in high standards and robust regulation, as we've discussed, how does this fare as an evaluation for an institution like the ECB, vital to the continuation of the EU's euro project?
Well, I know it's not good, is it? I would say I don't agree that the Bank of England should lend against mortgage bonds.
Mm-hmm.
I don't agree that they should lend against any asset that isn't classified as central bank money. So a government bond. To me, they have overstepped the mark since the global financial crisis. But the issue is how far they've overstepped the mark. And the type of bonds that the Bank of England will accept, I don't think they accept anything that's rated less than AA. So that's reasonable, okay. But during the pandemic, the ECB relaxed its criteria so that if the bond was already held, it could fall down to double B. That's speculative grade. That's not investment grade. That is so far away from being a central bank money asset that it shouldn't be doing that. So on the one hand, it says, oh, we insist on investment grade. And what they're trading on there is people think investment grade means AAA. They're insufficiently familiar with the ratings systems. So the lowest rating in Standard & Poor investment grade is BBB minus. Well, major corporates won't buy BBB minus assets. Their criteria would be they have to buy minimum A. If it drops to BBB plus, they have to sell it. So they're out of that thing well before it threatens to fall outside investment grade. But the ECB, the Euro system, is holding double B plus assets, speculative grade. So on the one hand, they always use the right language, but the detail it undermines the language. And it happens in things like when the treatment of bad loans by their banks, non-performing loans. Well, yes, the level of non-performing loans has fallen, and that's say, oh, that's a triumph. Yeah, it's fine. If you change the accounting standards, allow banks to do sham sell-offs of bad loans, where they sell the loans off to a special purpose company. The special purpose company issues bonds, and the bank buys all the bonds back. Well, that's an accounting trick. That's not improving the quality of the asset portfolio. Or when they have, for their banks, the way they have implemented this ratings-based, internal ratings-based system for evaluating risk. Well, they have implemented it weakly with important differences to the way it's been implemented around the world. The main one being is allowing member states to be 0% weighted when they don't have their own currency. So the words are right, everything gets implemented, but with fatal weaknesses. Without the weaknesses, the steam engine would come off its rails.
Yes, so it seems it seems to be more unstable than it initially appears.
Yes.
And it, as it were, it will lack the firepower, and it will lack the capital. It will lack the base, as it were, the base strength, it will lack the foundations to continue to support those member states it is supposed to
Yes.
be designed to support. So hence, far from providing that sort of stability that one will expect from a large institution, it might provide quite the opposite. So I guess now we're looking
Yes.
at the European Union on a more political level. And the European Union is an organization that is always looking to expand and have new member states. So what will be the implications that, say, a new member state that wants to join the European Union's monetary system, what implications
Yes.
will that have on those shadow liabilities that the EU has?
Well, the kind of member states that could still join,
Mhm.
they are quite small. I mean, at the moment, there are still 2 countries in the ERM. Now, Croatia just left the ERM to join the euro. Bulgaria and Denmark remain in the ERM. So Bulgaria recently took a decision not to proceed to euro membership in the near future because of the massive liabilities it would take on. And I think they've read some of my material, particularly about Target 2. So they've not given in to the pressure that was put on to them to come into the euro. Then you have Denmark. I mean, it's been in the European exchange rate mechanism for 20 or 30 years. Without it, it doesn't have an obligation to join the euro, though, but it's in it in all but name. So the countries, somewhere like Croatia, firstly, put under great pressure. Secondly, there seems to be a desire to show Serbia in a bad light. Oh, look at us, we're in the EU, now we're in the Euro, look at you. Well, is that a really good reason for going in there and taking on all these liabilities? But, the European Stability Mechanism would be big enough to bail out a country as small as Croatia. More the issue is, why would they take on liabilities that are a multiple of their own GDP? I mean, a big multiple. What's in it for them? Do they get more money? I suppose they believe they will get more grants and so on, and more money flowing in their direction than countries like Poland, who are loggerheads. So they see Euro membership, I presume, as a way of competing against countries outside the EU who will fall behind in their view, and other countries within the EU who are not towing the EU line. So Croatia will get more money. From a purely economic point of view or monetary point of view, it seems to have an awful lot of liabilities and very little upside. You give up a lot of power, and what do you receive in return? Well, you receive in grants, probably, if there are grants to be had. But if the grants dry up, all you're left with is the liabilities.
Well, wow. So it's I guess it's good news that officials in the Bulgarian Ministry of Finance have read your material, whilst
Well, I guess so, and material of others that have shown them, laid out what the risks would be. But also, there's a part of the political establishment who was highly in favour of joining the EU. And I think that faction lost out in recent elections. But who's to say that they won't get back into power later? Because it would be that Bulgaria remains in the exchange rate mechanism, in the euro waiting room. It's very, very difficult to get out of the euro waiting room, as the UK showed. You remain in it's very difficult to take a step back, but at least they've decided not to take a further step forward.
Yes. So one area that you mentioned earlier, as well as, sort of the implications of taking on more liabilities than one already has, is Target 2, which, for those who don't know, is the real-time gross settlement system for the euro system. And you argue here that they're lacking in transparency, that they're large, and they're impenetrable, and that they have weak documentation requirements, among other issues that you highlight. What would this suggest about the interdependent relationships between those national central banks within the European Union?
Well, I think it's indicative of that if it isn't blowing up directly, let's not think about it. So it's quite technocratic, even for central bankers, because it's payments. Payments is back office. That's like people sitting in some operations center in a suburb somewhere. We don't get involved in that. It's also completely automated. So management decisions are not required on a daily basis. It chugs along in the background. Better not to have to think about it, I think. So what the accounting of it, I mean, it's absolutely extraordinary, really, because at the Bank of England, the equivalent system, the different participating organizations, they must clear their current account to zero overnight. So the settlement account, your main account, has to be brought to zero. And then that money may be put into government bonds overnight. It may go to a reserve account, but the main account comes to zero. And that is an article of faith in payment systems. The main payment account has to come to zero, but not here. And it's not even clear, even to me, for all the work I've done, whether the accounts go to zero overnight or not. But what is clear is there is a netting. Now, when there's a netting, it means the amount before the netting was bigger than the amount after. That is undeniable. No netting. Netting reduces this and that to this and that. It reduces. So there's no doubt that the figures the ECB releases are before netting. No, sorry, I'm sorry, that's wrong. The figures the ECB releases are after netting. So what are figures before the netting? They are not available. But I work them out backwards through the different sets of accounts issued by the ECB. And it looked to me as if the gross amount before netting was double the amount after. So in fact, there's €3 trillion in target 2, not 1.5. And even the 1.5 is ridiculous. That should be naught. So you've got a system that should be naught, which is admitted to be 1.5 trillion, is actually 3. And the netting documentation, well, for one thing, and this, in my experience in corporate banking, and this is very familiar because these systems are very familiar in corporate banking, the accounting entries must follow precisely what the legal documents say. You can't have the one drifting off that way and the other one drifting off that way, because in a court of law, the judge would probably say, well, if it wasn't done according to this document operationally, I'm going to ignore the document and just look at the operations. But in target 2, it definitely isn't done according to the documents. So what's actually done operationally? It's easier not to look at it because it's all happening automatically, has never blown up as such overnight. But in fact, what it means is you've got one group of national central banks that owe 3 trillion and another that are owed 3 trillion. And we don't know. We know what it looks like after it's netted, but we don't know what it's like before it's netted. So what does that say? It says really that whatever things the European Central Bank Governing Council discussed, they never discussed this. And they're not accountable, because this is the area where the German academics try to launch multiple legal cases. And in the end, it was found that the ECB was beyond the jurisdiction of the member state. So they couldn't say anything. And the Bundesbank, here, the Bundesbank side with the ECB, because I have papers from them that say things that are not compatible with the legal documents. So very difficult.
So in the case of how the euro system operates, how the ECB operates, there ain't no SOP, and if there is one,
No,
it's not being complied to.
That's right.
And
We don't know what the accounting entries are, particularly over the period of the end of day, which only lasts for about 40 minutes. You know, knowing the IT architecture of Target, the idea that there's some kind of balancing of everything to zero, or the netting is operationally done via payments and then reversed immediately, because it's reversed immediately as well. At the end of the very short 45-minute end of day process, everything goes back to where it was. But the whole likelihood is it just stayed the way it was all the time. We don't know. It's impenetrable. But in this area, the participating national central banks are definitely with the ECB on this. They're not having a different view. They're giving out propaganda that makes it as if everything's all right. But then they have to issue annual books of account, and they show it definitely isn't all right.
Well, that's a lot of food for thought for the interview. So, Mr. Liddon,
Yes,
thank you very much for speaking to us about your book, Shadow Debts and Liabilities,
yes,
about the European Union's hidden debts and contingent liabilities, and the various implications that's going to have. I think, if for those who do read the book, you will see that there's his book goes into a lot more detail, with a lot more research and a lot more statistics that have been compiled to show to show this. Thank you, Mr. Liddon, for speaking to us. And Bob Liddon's book.
yeah, it's a great pleasure, Chris. Thank you.